All right, for more on the latest market moves as investors count down to Wednesday's Fed meeting, let's welcome in now Scott Chonert, Citi head of U.S. Equity Strategy. Scott, it is good to see you. So, Scott, we're wrapping up a great year here as we roll into 2025. You tell your clients, Scott, broadly stay positive. How come?
Well, I think the underlying fundamental trajectory is in really good shape. We've been pitching this no cycle thesis for the better part of this year, which basically says we're in this ongoing paradigm still coming out of the pandemic. And what we've seen is a fairly resilient fundamental circumstance and economic circumstance, even against 2 years of Fed hawkishness. So now we're kind of navigating, let's call it policy uncertainty with the new Trump platform, ultimately should give way to policy opportunity on the other side. All told, fundamentals look in really good shape going into 25 and should persist into 2026. This keeps us pretty constructive on U.S. equities.
Well, and Scott, that also implies that you think that policy uncertainty will resolve itself in a way that is favorable or at least not harmful to the earnings growth and stock returns that people have become accustomed to over the past few years.
So, we don't have a lot of information now relative to what we had even 2 or 3 months ago. So we've done a lot of back of the envelope modeling on this. And our high level takeaway is that we're probably going to see some company specific industry group or sector responses to some of the specifics around tariffs, deregulation, maybe tax reform and so forth. But all told, we're looking for low teens increase in S&P 500 earnings next year. And we don't think the Trump policy impact will detract too much from that underlying trend.
Scott, looking back on 2024, what surprised you as a strategist?
Yeah, I don't mean to say this in a sort of a comical fashion, but if we were having this discussion in the early part of January, and I would have told you that the S&P was going to finish the year 24, if not 25 times earnings, I'm not sure you would have invited me back on. But essentially what this has been one big valuation surprise. Earnings expectations for full year 24 are not too far off from where we were looking at the beginning of this year. So essentially it's been a valuation move dominated by the Mag 7 megacap growth cohort, but essentially it's been this ability of investors to look through a lot of the near-term noise around Fed and economic activity towards its underlying fundamental improvement, pricing in soft landing, AI growth tailwinds, and now to come probably still some opportunity around the Trump platform.
Scott, you mentioned valuation, and there was an interesting chart that you all put in your outlook where you looked at the forward price earnings ratio of the S&P 500, of the Magnificent Seven versus the S&P, and then versus the S&P minus the Magnificent Seven. Now, looking at this chart, it's clear, obviously, that the Mag 7 are trading at higher valuations. But what are your other takeaways from looking at how valuations have developed here?
So, this is the great storyline. So essentially, if you look at the Mag 7, their forward peg ratio, as we call it, has actually come down, right? So the Mag 7 is trading maybe 90th percentile versus history, but what's been happening is that the earnings growth has been so strong, it hasn't led to a dramatic valuation increase. These are high multiple companies anyway. On the other hand, the other 493, which is going to encompass the big chunk of the market, obviously, is actually trading at a more expensive valuation versus its own history. What this tells you is, to my earlier point, the market is quickly pricing in a lot of soft landing enthusiasm, AI tailwinds, and then, as I mentioned, the opportunity around the Trump policy platform. So it's this other 493 that we need to see stabilize from a fundamental perspective and then broaden, and we think that's going to be the case for next year.
Do you think, Scott, when you look at people, folks piling into these Mag 7 names, and you could look like an ETF like the Mags, for example, which is hitting the record. How much of that is earnings, Scott? And how much of that is also perhaps a defensive move here? Meaning, if you think inflation is maybe proven a little stickier than some imagined, and rates are higher for longer, investors start looking for what they would consider more defensive names.
Yeah, it's a really good point. So the way we're talking about it more recently is that we're thinking the Mag 7 actually unfold as a quasi staple, right? So usually you go to staples when you have uncertain economic conditions because of the persistence of earnings growth. The Mag 7, we think that forward-looking earnings growth certainly for 25 and probably into 26 is fairly visible. So all told, when you get concerned about other things that work in the market and the economy, the Mag 7 actually have this potential to be a quote defensive, if you will. We use the phrase growth is defensive periodically, and that's what's going on here. So essentially, I think that's what we are looking at is near term, let's call it 1, probably 2 years visibility. That's pretty good for these companies. What the issue becomes with them is whether that perpetuates in, say, years 3, 4, 5. And the market's starting to price in that perpetuation. So we need to be sensitive to both sides. These companies probably can't just live on meeting expectations. They need to continue to meet, beat, and then probably raise forward expectations as well.
Well, and Scott, sort of to put a fine point on this and also combine it with the last point you were making, everybody is talking about broadening, including you, and that is necessary for the rally to keep going. But it hasn't necessarily been necessary in the past. In other words, in the past, the Mag 7 going up was enough to pull along the rest of it. What changes in 2025 that that's not going to be enough anymore?
Yeah, well, I think it's law of numbers, law of large numbers, and can they continue to grow earnings at their current pace? One of the themes that we think is at play for next year is what we call earnings growth rate convergence. And essentially what happens, if you look at the projections for the Mag 7, they're still growing quite notably, but it's at a decelerating clip versus what 23 and 24 was. On the other hand, the other 493, the value side of the S&P, even going down into small mid-cap, all of them are coming off of relatively flattish earnings growth years where the inflection now presumes to be to an acceleration mode. And so what ends up happening is that the growth rates between mega-cap growth and these other elements of the market begin to converge. We think that's a really positive sign. And I think in terms of a healthy way to future market gains, you really want to see this broadening effect kick in, and we're pretty comfortable it will.
And Scott, you mentioned the Fed earlier. I'd love to get your take. What do you expect at the big meeting this week? What do you think they'll do, Scott? What should they do, in your opinion?
Well, I think another 25 basis points makes a lot of sense here. I mean, they're going down a less restrictive path for sure. We've begun talking a little bit more about a new Fed normal, and that is, I think equities are in good shape with the current market implied trajectory of, let's call it 100 basis point reduction over the next year. It's probably going to be with fits and starts, but all told, I think what we have to expect is that the Fed obviously has its eye on the ball here, and this gradual reduction in restrictiveness makes a ton of sense from our perspective. And so all told, what we're looking at the Fed is that it's going to be an important dynamic at work here. I think probably at the margin, we're going to be a little bit more focused on where some of these Trump policy proposals take us.
And finally, Scott, is there a place, beyond just the broad averages, are there specific sectors where you think investors should be looking next year?
Well, we haven't updated our year-end sector playbook, but going into Q4, we feel pretty good about the positioning. And essentially, we've been thinking about this fully valued market in a bit more of a, what do you like versus what you don't like. So we've been looking at sectors paired against each other. So for example, we've been talking about financials of an overweight versus healthcare underweight, consumer discretionary overweight, which has been pretty controversial against an industrials underweight, communication services, which is where you catch the internet names, overweight versus consumer staples. And then lastly, we've been working energy against materials. So all told, we think under the index surface, there are lots of pretty intriguing sector setups. Tech's a little bit unique here. We're market weight tech. We actually prefer semis a little bit more right now versus the strong performance we've seen recently in the software side.
Interesting. Well, we're going to talk about semis later in the show, so perfect timing. Scott, thank you so much. Appreciate your time today.
You bet.